What is going on, traders? So the bombshell CPI report just dropped today. Now, why is this important and why am I calling it a bombshell report? Not just because it came in higher than expected. Yes, it came in higher than expected, but guess what? If you've been following this channel, you know that 5 of the last 7 CPIs came in higher than expected. Now 6 of the last 8. But the forecast was extremely high. As a matter of fact, as you can see here, this is the highest forecast since October 2023. Now, March usually is a time when we see seasonal disinflation, right? After the holidays, prices start coming down, spending comes down. However, this is the highest CPI that we've seen since October 2023. So what does this mean for the markets? Well, as you guys know, the markets have been rallying really on the strength or on the belief, that the Fed was actually going to start cutting rates. You could see here, this is a historic rally in the S&P 500 on the belief that the Fed is going to cut rates. And if you've been following this channel for the last couple of months, you would know that I was very skeptical of this feeling here. How could the Fed possibly start even thinking about cutting rates when we are getting data point after data point showing us that the rate hikes that the Fed did really are not doing anything to fight those data points and ultimately bring inflation down? And we see that yet again, this time with a much hotter than expected inflation report. Now, I'm going to tell you what this means for the markets and how I'm going to be playing this, but let's just dive a little bit into why the inflation report came in higher than expected. Housing and gasoline, not a surprise. Again, something that we've been tracking here, showing that gas prices per barrel have increased 30% since December 2023. But housing and gasoline costs contributed more than half of the increase in the overall CPI. Now, you might say to yourself, well, the Fed actually likes to use the core CPI, and the core CPI strips out food and energy, which includes gasoline. Even core CPI came in hotter than expected. Now, one thing that is concerning to me here is what's going on with the yield curve. Now, you know, as I said before, that the bond market has been signaling the fact that the Fed is not going to cut rates. They don't believe the Fed. And I'm going to explain exactly how that is and why that is, okay? Even for people who might be beginners to the way that bonds and interest rates and how the Fed funds rate might affect it, it's going to be very understandable and palatable for you, okay? But you see here that the yield curve is once again flattening. Now, flattening meaning it's becoming more inverted, right? Meaning the 2-year is now shooting up disproportionate to the 10-year. And if you take a look at the 2-year government bond here, let me just go 0 to Y. If you take a look at the 2-year government bond here, this is actually pretty sad to see, because the 2-year was all the way down to 3.5% last year, when it looked like the fight with inflation has actually been working and that inflation was coming down precipitously and that the Fed is going to start cutting in 2024. As a matter of fact, summer of 2023, there were a projected 6 rate cuts for 2024. It looks like we're probably not even going to get 1, if that, right? So we take a look at the 2-year here. It is now almost back up to 5%. Now, the Fed funds rate affects the short term of the yield curve much more than the long term. Now, the reason that is because of this, and I promise I'm going to get back to the markets and do a quick market analysis and tell you how I'm going to be playing this. By the way, a lot of people laughed at me for selling some stocks a month ago, even though we've been in the same 1 to 2% range for the last 2 months. But that's neither here nor there. We'll get to that when we talk about the markets. If you take a look at the Fed funds rate, what does the Fed funds rate do? In short, okay, you guys like these cute little drawings here. Say that this is the Fed here. Now, when the Fed sets the Fed funds rate, what is the Fed funds rate? It is basically just a suggested rate that banks will need to, let's just say B for bank, and here's B, another bank, that when banks borrow from each other, and you might say to yourself, why do banks borrow from each other? Well, they do this on a daily basis in order to meet the reserve requirements. At the end of the day, some banks have less reserves than others, and in order to meet legal reserve requirements, they need to replenish those cash reserves overnight. So when they lend to each other, they are lending using the rate that the Fed is suggesting, right? So right now, the Fed funds rate, let's just say, for simplicity's sake, 5.25%, okay? Now, the reason that the Fed can do this is because when these banks need to borrow from the Fed, that's what the Fed is charging them, 5.25%. So that essentially becomes the de facto lending rate between banks, between the Fed and banks, etc., right? Let's just call this right here, and I'm simplifying it, but this is essentially what goes on, right? So this 5.25% is the rate that all of these entities use, the Fed, the banks between each other, etc. Now, with that said, if the banks can get 5.25%, basically overnight in the short term, then what are they going to be demanding from treasuries, right? If banks are going and institutions are going to be buying treasuries, and they can essentially get 5.25% for the shortest term duration loan, right? What are they going to be expecting from treasuries? They're going to want treasuries to pay a higher yield in the short term. And that's why the Fed funds rate, if we take a look here at bonds, let me just pull up the bond yields here. But if we take a look at bond yields, this is why the short term or the short end of the yield curve. So if you look at all of these right here, from the 1 month to the 2 year, they're all paying more than the long-term rates. And it's because of this Fed funds rate phenomenon where banks can get a high rate basically overnight. So obviously they're going to demand a higher yield from any of these short-term treasuries. Now, it's also the fact that bond investors might not be so gung-ho about the economy in the short term, and they might want to lock in yield for longer, so they invest in longer-term yields as well, and that then exacerbates this effect that I'm talking about, where the long-term yields are lower than the short-term yields, because the more that you invest, the more demand that a treasury has, right, the lower the yield. So if the longer-term treasuries have a higher demand, then those yields also come down. So those two things working in tandem are the real reason why you tend to see this yield curve inverting during these times when the Fed is trying to fight inflation. And this is what usually leads to a recession, because the yields stay there higher for longer and they start to affect everything in the economy, not only from the banking sector that holds a lot of treasuries, right? And if they hold old treasuries at lower yields and new ones are issued at much higher yields, then those old ones that they're holding on their balance sheet become less valuable. And that's why we saw a lot of the regional banks go bust last year, right? But everything from mortgages to car loans to business loans, et cetera, the yields, the higher yields, affect the economy entirely, right? And it is also a lagging effect. It's a lagging tool. That means that, just like boiling water, slow boiling water, right? You're going to crank that thing up, and it takes a lot of time for the water to boil, but before you know it, the water is boiling and it's spilling everywhere, right? It's the same thing here, right? They crank up the interest rates. It looks like it's not working. And then finally, the economy is literally boiling. And that's when things start to break, right? But this was my suspicion with the fact that the Fed can achieve a soft landing, because as we near the end of the inflation fighting cycle, there tends to be more enthusiasm, and then inflation kicks back up. And that's why it's so hard to defeat. And that's why we've never seen a soft landing. And that's part of the reason why in my last video, Jamie Dimon issued a warning saying that the chance of a soft landing are much, much less than the market is currently pricing in. So before we jump into the markets and I tell you how I'm going to play this and I give you my plays, let us just take one quick look at the Fed funds rate. Now, as I've said, there's no way that the Fed is going to cut in May. And now you can see the likelihood of them cutting is only 3%, where this was much higher just a month ago at 23%. And I said in June, there's no way that the Fed is going to cut. And after this bombshell report today, 3.5% CPI, we see that the chances of the Fed cutting are 18%, when just a week ago, this was at 61%, and I don't know how, okay? I don't know how the market was betting that the Fed was going to cut. The bond market was already telling us that things were getting scary, and that's why yields were spiking, right? And obviously the stock market is like the dumb stepchild, right? It's the one that's going to keep rallying until it's too late. It's usually the last thing to get the memo. But lucky for you if you're a stock investor. But in July, you can see here now that even in July, the most likely scenario is that the Fed skips. There is currently a 38% chance, based on how the institutions are projecting there's a 38% chance that the Fed cuts. Again, a week ago, this was at 52%. So we don't see the first probability of a rate cut now until September. So if September is the first rate cut, we only have 3 Fed meetings after September, right? There's only 2 after September. So including September, there's 3. There's September, November, and December. So realistically, even if the Fed cuts once at every one of those meetings, we only have 3 rate cuts versus the 6 that was projected last year. I personally think that the only way the Fed cuts rates in September is if something between now and September breaks. So I don't think the Fed is going to cut rates, based on some sort of achievement that they've now brought inflation down to 2%. I've gone over the history of inflation and how hard inflation is to beat when it is in the single digits. We've seen before that it has taken 2 to 4 years just to get inflation down from 3% to 2%. So I'm not hopeful for this based on the track record. Obviously, I'm not Nostradamus, but I do have the data in front of me. So I personally don't think that the Fed is going to cut in September unless something breaks, right? Then the Fed will cut in September, but it won't be because they've achieved a soft landing, in my humble opinion, right? So realistically, there aren't that many Fed meetings after September in order for the Fed to cut significantly. And I think that once the stock market gets that memo, then we are going to see some weakness, as we are currently seeing right now in the stock market. Now, as I said before, in the beginning of March, I started offloading some positions, some swing midterm positions, okay? And it's crazy that really since March, we've been trading in this very tight range here. We haven't moved out of this range. Now, this is part of the reason why I said also that, in my opinion, the best way to hedge is by using the VIX. And when you look at the VIX here, and I guess we'll jump into the plays, but when you look at the VIX here, the VIX has been rather predictable all year. Below 13 has been the sweet spot for the VIX. So every time it gets below 13, I end up buying VIX calls. Now, another thing that I've been doing, and I've talked about it candidly on this channel, it's actually a play that I gave you guys, is I've been selling calls against my shares. You can see here, these are my Tesla covered calls at 200. I sold these just yesterday, a new round of covered calls. In one day, these are up already 42%. So I've captured a bulk of the premium already on these covered calls, right? I'm not shorting here until or unless we start breaking structure. So, what can happen here is, the market can continue to go up. The market can just be ugly and sideways until July, when we usually have bullish seasonality, right? But I'm not keen on shorting the market here unless we get below this level on the SPY, which is around 508, and on QQQ until we get below really 421 on QQQ. Otherwise, I'm not keen on shorting the market here. There are other ways that I can generate income. Obviously, there are day trades. I gave you guys the gold short this morning on the live stream. Shout out to those of you that joined the CPI live stream. But gold ended up tanking later in the day, and tanking even more than I thought it would. So there are other means of generating income than just, blindly trying to short the indices, which have been the most bullish. This has been a historic run, right? Like I said before, you can wait for structure to break before you short the indices. But selling covered calls is a great way to generate income against shares that you want to hold. Obviously, I day trade futures every single day with the group. And if you want to sign up to the group and you want to day trade futures with us, and you want to swing trade options with us, and you want to get all of my option selling alerts on time, click the link in the description below. Use the coupon code SPRING99 for $99 a month for life. Make sure that you use that coupon code if you want to join. Also, we do have a free mastermind coming up on April 21st, and you have to be on the wait list below. The first 1,000 people get in. After 1,000, we cap it, and we don't accept any more people until the next time that we do it. So if you want to join the free trading mastermind and you want to learn how to trade, and you want to learn how to do the things that you see me do on the live streams, live in front of thousands of people, make sure you click the link in the description. It's absolutely free. Join the free mastermind on April 21st. But that is really how I'm playing it. Like I said, VIX calls for me below 13 are a no-brainer. Not shorting the indices until we break market structure. Selling covered calls And then obviously day trading every single day, day trading futures, right? So sign up using the link below. Let me know in the description how you are playing this. What do you think? What did you think of the inflation report? Do you think the market is just going to keep rallying into the election? Are you hedging? Do you have cash on the sideline? Are you waiting to get in? I'd love to hear from you guys. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.